In part 3, we will examine the claim by Islamic banks that they do legitimate trading and earn legitimate profit, and that their profit is not interest. We will look at how interest is incorporated into the sale price, and we will examine whether we are introducing any element that may be haram. And we will look at how Islamic banks always do combinations of contracts, not a single contract, and how these combinations can lead something that looks halal that in fact may not be halal. Okay, so we've discussed it's always applied in deferred payments to the bank. So we now have a sale priced at interest. Okay, but interest is called profit. So this is an important point, the use of the word profit, right? Because now the claim is made that Islamic banks are trading, they're selling assets, and they're entitled to make a profit like any trader. Okay, so there's lots of implications in this claim, right? It's a subtle claim to make. On the face of it, it looks very simple. So they say be entitled to make a profit. But we've seen that it's benchmarked to an interest rate. Okay, so the claim is now, according to the Islamic banks, that it doesn't matter what it's benchmarked to. It's still a legitimate sale. Right, and it meets the requirements of a sale according to Sharia, and the price is agreed. It's agreed between the two parties, and they say, so what if it's benchmarked to an interest rate? And the price is explicit. It's, you know, the rate, as I mentioned, is transformed into, from an interest rate times it into a cash amount, right? And this is the profit amount. So the price is agreed. There's no uncertainty. So the claim made by Islamic banking is that this process of benchmarking to interest, it's permissible. Benchmarking to LIBOR, it's permissible. This is the major claim made by Islamic banking. Okay, so here, so here let's talk about the point. I mean, are they turning something that looks like it's halal into something that's haram, and is it an exercise to hide a riba? So we have a sale of a legitimate asset, and we have the two parties agreeing the price. The price can be anything. So these are all standard rules in Islamic commercial law. Now we add LIBOR as a reference. Okay, and we defer the repayment. So we have an interest-based loan, and this is my main point here. Okay, so if you have A, so it's B, so we have the Islamic bank and you're the customer here. So what you're doing is that you're receiving a TV and you're paying 105 in 1 year's time. Okay, and the bank is selling you the TV. So why are we doing this? Why is the bank buying the TV from the supplier, paying 100, right? And then, you know, doing this first because you can't be short selling. Then this, the second transaction is this one. So why are we doing this? Because in theory, you know, let's put the seller here, the seller of the TV. I mean, if you wanted to, you could go straight to the seller, right? And you could buy the TV directly for 100. But the point is that you can't, that you don't have the money to pay him 100, right? You don't have it. That's why you go to the bank for a loan, right? If you had it, you would do this and pay 100 now. So that's why you go to the bank, you ask the bank to buy the TV from this guy, and that you'll pay the bank in a year. So what you're doing is the bank is stepping in the middle, right? The bank is effectively, he's paying the money now to the seller, and you're paying the bank in one year, 105. Right, so this is no difference, for example, for you. So this is what you do in a conventional sense. So let's put B as a customer. You'd go to the conventional bank, and let's say we have the seller of the TV here. You would just say to the bank, give me a loan of 100, right? And the bank will say, yeah, you pay me interest of 5%, and after 1 year, you pay me back 105, right? So, but of course, this is haram. This is riba, right? And then as a customer, what you do when you receive the 100, you pay to the TV seller, and he would give you the TV, right? So he's sold the TV and he's got his money immediately. And so there's two transactions here. First you get the loan, then you pay this, but the bank's not involved with the seller at all. And there's no need. In conventional banking, they don't need to. They will just give you a loan and you buy it. But this is haram, right? So what we're doing here, I hope you can see that we're just replicating the exact same cash flows we see with a haram loan based on interest. But this now, instead of, you know, this 5% being riba, but now this 5% is profit, right? So you can see the whole point of this exercise. It converts the riba into trading profit, but my point is this is just another way to hide riba. So this is an interesting number of steps that the Islamic banks take. Right? If you look at each thing on its own, it looks Sharia compliant, right? So let's go back to our example. So let's have the Islamic bank and the customer, and now we have the seller of the TV. So there are two transactions taking place. First, the bank buys the TV and it pays 100. Right? So this is claimed to be a legitimate transaction because it's everything, it meets the requirements of a sale transaction, right? No uncertainty in the type of good, price is agreed, and the price is paid now or it can be paid in the future. Both are permissible, but this is paid now. So this is the first transaction. And then there's a second transaction where the TV is sold to the customer, to us, and we pay 105 in 1 year's time. Okay, so these are two legitimate sale transactions. So this is the point, that if you take one on its own, it's halal, right? There's nothing on the face of it that makes it not halal, and two is halal because it meets the requirements of a sale transaction. But the point is that these are connected, right? These are not independent transactions, right? The bank only buys the TV here in one because it knows it can sell it to you in two. And in fact, in most cases, in every single case I've heard of in Islamic banking, as a client, you're required to make a promise, a written promise to the bank that you're going to buy it after the bank buys the goods. Right? So these are connected transactions. And to claim that they're not connected is just, it shows complete ignorance. If you claim that, anybody who claims that they're not connected, it shows complete ignorance of how the system works. So the point is that when you combine them, we get something very different. We get, what is, a pure replication of an interest-based loan. Right, so it's a riba trick. I mean, this is specific wording that I use because this is wording used by AOFI, which is, one of the largest global regulators in Islamic banking for Sharia standards. I'll explain why I use that word. So, Bayl Inna. So this is what AOFI have said is a riba trick. So AOFI, I mean, this is a body you can Google. This is the Accounting and Auditing Organization of Islamic Financial Institutions. They're based in Bahrain. And they have, as far as I can tell, they have Sharia standards, and these are quite good. I would say they're not very good, but they're quite good. Okay, they're not obligatory for all banks to use, but quite a few countries do use them. In Malaysia, they don't. Malaysia have their own Sharia standards from the, not from the SEC, from Sharia supervisory body which works the Bank Negara. Okay, so they're not obliged to follow the AOFI Sharia standards, but they have their own Sharia standards. And my view is that, the standards in Malaysia are less good than AOFI. The AOFIs are not perfect; they're very far from perfect, but the Malaysian standards are a bit worse. So, AOFI refer to Bayl Inna, and they say this is a riba trick, right? So this is not, it's not a surprise. I mean, Bayl Inna is impermissible in all four schools of law, if it's organized, right? Even in the Shafi school of law, which is followed in Malaysia, it says a riba trick. In part 4, we will look at how transactions can be combined in order to deliver an outcome that is exactly like riba. And we will look at the kinds of approvals that scholars give to Islamic banks, and then what they actually do with these approvals. And we will look at the claim that Islamic banks' activity is one of deception, based on using profit when in fact they are just replicating interest. And we will look at the claims of how Islamic banking can deal with long-term economic problems that are from capitalism and long-term debt, and how it can be used to support green finance and SDG goals. And we will see whether these claims are in fact greenwashing or sincere.